Hey, what's up guys, how are you? Simon from the Stock Talk here, back with another top stock pick video. Except today, we're not recommending stocks to buy, rather stocks to avoid this coming fall. While the stock market is home to the highest highs, there can still be periods of downturn. But it's a good thing I'm here to steer you well clear of any potential pitfalls of this financial realm. Make sure you stay until the end because you wouldn't want to buy into anything that is performing below par. And there are definitely a couple of stocks you wouldn't expect to see on this list. So, let's get into it, shall we? The first stock on our list was one of the heroes of last year's Reddit stock short fiasco, but its time in the spotlight looks like it might be drawing to a close. Your long-lost favourite, GameStop Corp, ticker GME. It made significant headwind in share price, but the stark reality of their financial situation has begun to take its toll, which we may all be aware of by now. Operating losses continue to rise as the company struggles with its place in the gaming market. And even aside from its struggling popularity, tightened spending habits of consumers as a result of inflation are leaving the video game industry as a whole levels well below where they were. Without a clear idea of where they're going as a brand, GameStop could struggle to stay afloat in the coming years. And I'm here to say to take a rain check on this one for now. Another company being hit quite hard by inflation is online retailer Wayfair Inc., ticker W. What? You may be wondering. Not Wayfair. I got my favourite lamp from Wayfair. But unfortunately, yes, we're serious. Consumer spending on non-essential items has decreased a bunch. And when combined with supply chain disruptions, Wayfair is beginning to feel the squeeze. Q2 financials are not looking too good either, with the net income and earnings per share dropping significantly. The stock is down by 65% this year, and the light hasn't quite appeared at the end of the tunnel. So now could be a good time for investors to sell and avoid. Now, I'm glad you're still with us, because this next one is an app that we're all familiar with, and even use pretty regularly. Social media giant Snap, the parent company of Snapchat, ticker SNAP, is looking pretty fragile at the moment. Since they announced a profit warning in May for the coming months, the stock has been in a negative spiral, losing 40% of its value in just a few weeks. Uh-oh. While other social media companies are also feeling the squeeze, Snap's losses dwarf them in comparison. And I mean, come on, its sad revenue numbers are certainly not helping this situation. Without any clear vision for the future, it could be a rough ride in the coming months for the company, so it's probably best to give this one a miss right now. It's no secret that bad PR can severely impact the price of a stock, and the next company on our list has been on the receiving end of a recent backlash. While Biogen Inc., ticker BIIB, comfortably beat their revenue and earnings per share targets, they are under scrutiny regarding the pricing of one of their latest Alzheimer treatments. Unsurprisingly, many insurers are unwilling to cover the $28,000 price tag for the treatment, and Biogen has made no move to combat this situation. A shame, right? A long history of price gouging in the US means this issue has hit a sore spot within the medical industry, and only time will tell if the company can recover its reputation. Now, one company that did soar to stock stardom during the pandemic was Car Van Co., ticker CVNA. The online retailer allowed consumers to buy and sell vehicles from the comfort of their own homes and required no person-to-person interaction. Wow. But now it appears that people are returning to traditional forms of car purchase, or just not purchasing at all. Either reason unfortunately leads to the same outcome for the company, who missed their financial goals for Q2 and experienced an 80% price drop in the last year alone. We would definitely recommend selling this stock if you have it in your portfolio. Speaking of vehicles, the next stock on our list may not be one you expected to see. Tesla, ticker TSLA, had an astronomical rise to fame, seeing share prices soar 1,200% over the last 5 years. But don't let that fool you, because questions regarding supply chain issues and the dedication of their CEO Elon Musk are casting doubts over its near future. While it's very unlikely for the company to collapse, it may be worth waiting a while to see how everything plays out before sinking your hard-earned money into this stock. The final stock on our list is a Singapore-based rideshare provider specialising in food delivery services. While Grab Holdings, ticker GRAB, established a significant presence in several Southeast Asian countries, an unfavourable SBAC merger saw their stock price drop by around 35% overnight. This, alongside the loss of 2 senior execs, demonstrates some internal issues with the company, and the looming global recession doesn't look to be helping matters. So it's definitely worth holding off on this stock right now. And unfortunately, that's all for today, folks. But before we go, remember we're never trying to be negative Nellies here at the Stock Dork. These are very pressing times we're living in, and we want to make sure that you are making the best choices for your portfolios. There's no reason why all of these stocks from today can't turn the performances around in the coming years, but in our opinion, it's best to steer clear for the time being. Let us know in the comments if there's any other stock investors should be avoiding right now. We want to know what you think. If you enjoyed the video, be sure to check out our latest step-by-step guides to investing. There's some great info in there that will be of use to you. As always, take care everyone, and I'll see you in the next one.